Fantastic stuff. Thank you for joining us. Nilesh is back from his big roadshow from US. And Nilesh, we'll talk about the specifics of the roadshow and what your key takeaway has been. But how should market read into this so-called standoff between RBI and the government now? Should markets get nervous, or this is something which has happened in the past also and we should move on?
So in the past also there has been differences of opinion between RBI and the government, but clearly they have been managed in a within closed door corridor rather than out in the market. Clearly we need magnanimity from both the sides. There will be always difference of opinion between a central bank and the government. Today, if we look at US economy, President Trump has been going berserk about Jeremy Powell, about how he is raising interest rates earlier than necessary. So there is attraction between the central bank and the government all over the world, but these matters are better resolved through consultation in closed door rather than out in the open.
So Nilesh, what are you trying to imply? Get nervous, don't get nervous.
I'm not really sure, because clearly market has discounted whatever is there in the public domain, and lot will depend upon how events shape up. It's quite possible that, like in the past, RBI and government will sit across the table and resolve their differences. In that case, market has no reasons to be nervous. On the other hand, reverse could also happen, and then there is all the reasons for market to be nervous. So this is a binary event. We just hope and pray that it will get settled like it has always get settled in the past.
Nilesh, up until now, the market really seems to be putting on the back burner the fact that crude has declined to a 2-month low. I mean, we're looking at Brent levels of 76, 75 thereabouts. Do you think there's much of uncertainty outside what crude markets are doing? I mean, why is it that it seems that the market is ignoring the fact that there's been such a significant cool-off?
So one, it's not that market has not taken into account crude price drop, but the fact remains that the September 18 quarterly result numbers have come little bit subdued than market's expectation. Of course, there are few companies which have delivered beyond expectation results, but they are far and few between. Majority of companies have delivered around expectations or slightly below expectation results, and probably this subdued results of September 18 quarter is impacting market to be kind of ignoring the crude price drop.
The pain is behind us. I mean, we've already factored in, or rather we're already seeing an earnings absorption. Crude also seems like there's at least a little bit of uncertainty removed and behind us. We don't know still what's going to happen in Iran beginning of November. But it seems like directionally at least those peaks are over from those $80 kind of levels. Or do you believe that there is still a lot of uncertainty left? You don't know which way rupee is still going to move. You don't know what's going to happen from the state elections and then the general elections thereof. How much more of a rate hike is Fed going to have, and how much more are global markets going to correct, because the sneezing and the coughing have just about started there.
So essentially, if we see over last 1 year, India was caught in a perfect storm. Oil prices went up from $55 to now $75. That movement prompted rupee to depreciate because it was appreciating between 2013 to 2017. Depreciating rupee prompted RBI to sell dollar, and that took away rupee liquidity in banking system. That raised short-term interest rates, and that probably resulted into ILFS kind of credit event. And finally, a sum of all that was reflected into stock market, where small cap index is down almost 40% plus from the top. Now, the good news is that majority of bad news, other than few things, has been into the prices. Rupee's overvaluation has been corrected to a great extent. Interest rates, after rising relentlessly, has started coming down with RBI's OMO. RBI is pushing liquidity through open market operations and LCR relaxations. The oil prices have also softened a little bit. So put all these things together, a lot of bad news is reflected into the prices. The valuation of stock market, which was at a premium to its 10-year historical price to book, is now at a discount or at around fair value. The small cap index was at about 33% premium to its 10-year historical price to book average on Jan 2018. Today it is at 10% discount. The large cap was at 10% premium. Today it is at 4% discount. So valuations have come down from premium to around fair value, little below fair value for large cap as well as small cap. Now going forward, I believe markets will be impacted by two things. One, trajectory of oil, and second, election. If oil goes to $100 a barrel, certainly from current level there will be downside to the market. If election produces a coalition government, then certainly there could be downside from the market. On the other hand, if we get little lucky with oil and we vote sensibly to get a stable government, then there is upside from the market. So oil and election to a great extent will be driver for the market in the next 6 to 8 months.
What would be a portfolio setup at the current juncture then, Nilesh? Would one be aligned towards being more defensive? How would you balance between risk and return given the outlook that you've just laid out?
So one, with the rupee depreciation, there has been a great advantage to companies which are exporting goods and services from India, as well as to those companies which were facing unfair import dumping from China. So this is one theme in exports related or import substitution where some of the companies and some of the sectors could be great opportunity. The second thing which is happening, and it's an opportunity of our lifetime, is related to supply chain disruption which is being caused because US has imposed huge amount of tariff on variety of goods from China. If you see inorganic chemical industries, it's showing volume growth of about 40% quarter on quarter for last 3 quarters, 40% year on year for last 3 quarters. This is happening because one, rupee depreciation has given some breathing space to inorganic chemical manufacturers, and second, China has been moving away from that market, and that's allowing Indian companies to go and capture export orders. Now there is this kind of supply chain disruption is occurring in various other parts. Last week The Economist published an article how supply chain disruption is moving manufacturing from China to other countries. Footwear is going to Cambodia, food processing is going to Vietnam, electronics is going to Malaysia and Thailand, computers are going to Taiwan, clothing is going to Bangladesh. Now clearly this is our opportunity. We have ability to make footwear, clothing, computers, electronics and other items. If we can take away that manufacturing base from China, there will be huge opportunity. Those opportunities could be there in varied sector, and I hope and pray that we go and capture that opportunity. So we will be clearly looking forward to that supply chain disruption which can come in favor of Indian companies, courtesy tariff for imposed by US on China and courtesy rupee remaining around its fair value.
Nilesh, the concern which perhaps no one is talking about, the fact that we've seen a big crowded trade in the world reversing, and the trade is FANG, Facebook, Amazon, Alphabet, Netflix. That is where the bulk of the stock market, global stock market concentration and ETF concentration is. Some of these stocks have corrected 10 to 15%. What will be the implications of this reversal in trade, and could that impact emerging markets a bit more?
So when I was in US, Nikunj, one question which didn't come pointedly but did came between the lines: why should we invest in emerging market? Over 5, 10, 15, 20, 30 years, American markets have delivered better return than emerging market. And frankly speaking, I was really running out of answers because the numbers represent that for the American investors, it made sense to invest in American market rather than emerging market. US markets have outperformed virtually all emerging markets. Now that large part of outperformance has come because of FANG stocks, and if FANG stocks starts coming down, then certainly there will be one cause or one reason for investors to diversify away from US markets into emerging markets. It is extremely important for emerging markets' sake that American stock market and emerging market stock markets return differentia, kind of reverses, where emerging market starts outperforming American market for attracting American capital. The second thing which will happen with this FANG stocks correction is that it will allow other companies, other sectors to go up in terms of valuation. A lot of money was chasing FANG stocks because many people were underweight these stocks, and that resulted into taking capital out of many other sectors, many other companies. So we do expect a reasonable distribution of capital across non-technology, non-FANG stocks as FANG stocks starts underperforming the market. But again, we believe the correction in FANG stock will be short-lived. The world has changed, and that change has been brought by this FANG stocks. So it is not that we are going into 2000 kind of scenario where many .com websites and .com companies disappeared. There will be price correction, but these companies will continue to exist and prosper.
Nilesh's answer on emerging markets and America is making his dog also a little nervous.
So Nilesh, I guess there is some agreement which clearly seems to be coming from everywhere on your thoughts, but a little bit of disagreement which could challenge the market optimism is that because of a crunch in liquidity, your credit offtake may start slowing down, your consumer spending will start slowing down, and that could challenge your FY19 and FY20 estimates.
Undoubtedly, Nikunj, that is the big risk which Indian market and Indian economy is facing. Last year, we had seen 1/3 of the credit coming from public sector banks, essentially majority from non-PCA bank. 1/3 of the credit came from private sector banks, and 1/3 of the credit came from NBFC. Now today, as we stand, the PCA banks are not able to lend credit. The private sector banks and non-PCA PSU banks will continue to lend credit, but they will have a limitation. And the entire NBFC sector, which was funding credit to real estate sector, to small and medium enterprises, to all those activities which banks would not have financed, that entire sector is coming to a slowdown. It's coming to a grinding halt in some cases. It's coming to slow down in many cases. So if we don't provide adequate credit to the economy, undoubtedly there will be impact onto the GDP growth and invariably on corporate earnings. We were talking to few electronics distributors in Mumbai, and they are saying there is a reasonable amount of slowdown in footfalls as well as sales, primarily because many NBFCs are not in a position to provide consumer durable financing. Now when NBFCs step out of consumer financing, probably banks can step into automobile financing. They have requisite expertise to provide financing for two-wheelers, four-wheelers, commercial vehicles. But they really don't have expertise to provide financing for washing machine and television and refrigerator. That space was exclusive domain of many of the NBFCs, and there is a slowdown coming, and that slowdown will be reflected into consumer durables. So it is extremely important that we check the boxes. One, there should be systematic liquidity. Liquidity cannot be negative, so that there is availability of capital to everyone. Second, that capital should be available at appropriate cost. Today we have slightly higher real interest rates. It needs to be normalized, and fortunately we have seen some reversal in 10-year yield from 8.25 to 7.90. And third, there should be transmission of that liquidity at appropriate rates to the needy sector. Now PCA banks are out of the system from a lending point of view, so NBFC has to take the load, and there should be transmission of liquidity at appropriate rates to the NBFC sector, so that the economy continues to get the credit which is so necessary for the growth.
Okay, so Nilesh, closing comments. I'm sure we'll interact before the 3 months, but 3 months from now, what do you think we could be staring at?
We just need to be lucky and we need to be sensible. If we are lucky in oil and we are sensible in voting, Nifty will be higher than current level. If we are unlucky about oil and we are not voting sensibly, then Nifty will be lower than current level. And even my dog seems to be agreeing to it.
Next time we should have the poor pet.
Exactly.
I'm sure he's locked up in some room because Nilesh is
Yeah, but Nilesh is not answering my question. What is sensible voting?
That's true.
It's all about a stable government. And before I close, Nikunj, I just want to take liberty of pointing out one thing. This is related to MSCI emerging market indices. India's weight in MSCI emerging market indices is about 8%. China's weight is about 28%. Most of the investors I met expressed concern as to how their portfolios are going to get impacted as China's weight in MSCI emerging market indices will increase from almost 28% to more than 50%. Their doubling of weight will result into lowering of India's weight. Today, majority of investors are overweight India, and from being overweight, they'll become extremely overweight as our weight reduces. Majority of investors are underweight China, and they will become extremely underweight China as China's weight doubles. This will have serious implications about FII allocation to India as well as to their existing holding in India. We must engage with investors to engage with MSCI that they should not make MSCI emerging market indices MSCI China indices and other emerging markets. It should retain diversified nature. It should give fair representation to Indian equities. Today, many of our large companies like HDFC Bank, many PSUs, IndusInd Bank, Kotak Bank are not part of the MSCI emerging market indices, and we must engage with investors to ensure that when China's weight increases in indices, our weight does not reduce correspondingly. That will ensure that FII's allocation to India continues to remain stable. Otherwise, we could see a dramatic reversal in FII allocation as well as selling from their existing holding.
Alright, Nilesh, good to have you back. Thank you for joining us, and thank you for your valuable time.
Thank you.